Shocking report shows the dollar is losing ground against foreign currencies, threatening its status as a global reserve. I'm your host, Steven Van Metre, and thanks for joining me today. A recent International Monetary Fund report shows the dollar is losing ground and weakening against foreign currencies, threatening its dominance as a global reserve. But are they right? Well, let's find out. Let's head over to this headline. The dollar share of the global reserve currencies has been steadily in decline over the past 20 years as central banks turn to non-traditional currencies, including the renminbi, to diversify their holdings. Reserve managers have moved out of dollars in two directions, with 1/4 headed into the renminbi and 3/4 into currencies of smaller countries that have traditionally played a limited role as reserve assets. And that's one of the big concerns investors have over the long term, is losing the dollar status as a global reserve to countries like China. But is that all going to happen? Well, the findings are in a new paper issued by the International Monetary Fund titled The Stealth Erosion of Dollar Dominance, Active Diversifiers, and the Rise of Non-Traditional Reserve Currencies. A characterization of the evolution of the international reserve system in the last 20 years is thus its gradual movement away from the dollar, a recent, if still modest, rise in the role of the renminbi, and changes in market liquidity, relative returns, and reserve management, enhancing the attractions of non-traditional reserve currencies. These observations provide hints of how the international system may evolve going forward. And what all that indicates is that there is a slow move away from the dollar. But will it actually last? Because again, most people believe China is going to take over as a global reserve at some point. But is that even possible? While China's currency is gaining some ground, there's also a notable shift into currencies, including the Australian dollar, Canadian dollar, Singapore dollar, Korean won, and Swedish krona, according to the paper. This shift is broad-based, and they identified 46 active diversifiers that have shifted their portfolios in this direction, such that they now hold at least 5%. Which is still a small but important number of the reserves in non-traditional currencies. But yet still China's currencies has struggled to gain market share in the global transactions as the government enforces strict controls on the flow of money in and out of the country. And that is an important thing to understand, is China limits its ability for its people to have the currency flow out of the country. And if you're a global reserve, you almost need to have a revolving door where your currency can move in and out without anyone putting controls on it. The latest data from the Society of Worldwide Interbank Financial Telecommunications shows the renminbi remains ranked as 5th most widely used currency for global transactions, unchanged from last year. So can the Chinese renminbi or yuan upset the dollar? Well, unsurprising, dollar's dominance over the world is a near impossible task, as America's deep capital markets and economy is seen unparalleled. And that's the conclusion of investors after Washington's freeze of Russia's dollar's holdings. And see, that's what the story is really about, is this conflict with Ukraine has allowed the United States to effectively freeze another country's dollars. And that's what everyone's looking at. Is the United States too powerful? Is the dollar too dominant, where we can effectively shut everyone off from using our currency at any moment's notice? And that's why you're starting to see talk about diversification away from the dollar. But does that mean the dollar's role as a global reserve is ending? Well, we'll see. Created fresh impetus among central bankers to rethink the security of access to foreign exchange reserves. The move fueled speculation that countries such as China could redouble their efforts to unshackle itself from greenback-denominated financial system and look for alternatives. While Goldman Sachs and Credit Suisse have flagged threats to the dollar supremacy, finding a valid replacement is going to be extremely challenging, according to funds from Brandywine Global Investment and JP Morgan. And of course, not to leave out our friend Jeff Snyder, who has talked about this for a long time, saying the dollar isn't perfect, but there really is no alternative to it right now. There is not even talk of an alternative. The size and strength of the world's largest economy is unparalleled. Treasuries are still one of the safest ways to store money, and the dollar remains preeminent beneficiary of haven flows. And now, if your portfolio is denominated in dollars, well, I've got something for you. You should check out Portfolio Shield and compare it to what you've got now. I'll put a link up in the corner here in the description below. You'll be glad you did. Now, let's talk about what's going on with currencies here, because the idea that countries like China are suddenly going to stop using the dollar or going to try to fade it out is really not possible, because when you trade with the United States, you get dollars in return. And what do they do with those dollars? Well, either they hold some of them or they convert them to U.S. Treasuries, which are a form of deferred dollars. And so let's look at where all these dollars are held outside the United States. And every month, the U.S. government publishes the foreign holders of Treasury securities report, and you can see they list from who has the most and on down. And currently, you see Treasuries, which again are a form of deferred dollars, $7.66 trillion held by outside sources. So the idea that all of a sudden that's going to end, well, I've heard that for the last 40 years, and so far that number you saw on your screen keeps going higher, because there's not only demand for dollars, but it's part of how the system works. Again, when you trade with the United States, you get dollars. The idea that you're going to take those dollars and say, well, I don't want those, I'm going to put them in other currencies, well, it doesn't make sense. You put them in Treasuries because that's your dollar savings account. That's how the system works. That's why people aren't moving away from the dollar. Now, there are simply no other options at this stage in the game, as I pointed out moments ago. Of course, according to our friend Jeff Snyder and Mark Mobius, 4-decade market veteran and founder of Mobius Capital Partners. The dollar is still strong and will probably get stronger if tensions can continue to escalate. Well, I've got news for you, Mark. The dollar is going to get stronger no matter what goes on in Ukraine, and I want to show you why, and I want you, my friends, to understand as well. So when the Fed tightens monetary policy, and you'll note they're raising the federal funds rate. Now, unfortunately, the Fed database doesn't have a long history on the nominal dollar for us to look at. But what I want you to understand is when a central bank raises interest rates, they're trying to encourage dollars to come into the banking system. So remember, we talked about this a couple weeks back when the Russian central bank raised their federal version of federal funds rate to 20% to pull dollars into the system, to keep them from moving around. And when you keep dollars from moving around, well, the value of those dollars that are outside, not sitting in bank accounts, well, it goes up in value. And I want you to see here again on this chart, you'll notice that as the federal funds rate is headed higher starting in late 2015, the dollar starts gaining strength ahead of that as the market starts to anticipate the value of the dollar increasing. And so now, as we know, the federal funds rate is headed higher. What does that mean for the dollar? Well, it's headed higher. And when we start talking about Treasury securities, which are deferred versions of dollars, you'll note that when the Fed enters a tightening cycle, we can go back to the 90s, there's a knee-jerk reaction. We're looking at the 10-year Treasury yield here in red, that it pops up and then it comes down. And you see it pops up and it comes down. And you'll want to note that it makes new all-time lows every time. So at some point during the tightening cycle, and now as we get into the early 2000s, you'll notice that the relationship between the federal funds rate and the 10-year Treasury yields gets weaker. It doesn't go up as much, and then it comes down and makes new all-time lows. And now there wasn't even a tightening cycle here, but nevertheless, the yields came down. And so we see here in 2016, there's a knee-jerk reaction, rates higher, and come crashing down to new all-time lows. And the reason that happens is because as the dollar gets stronger in value, as we've talked about in prior shows, and I've shown you the relationship, the value in bonds increases. So everyone right now thinks the dollar is going to weaken. But note, when you have foreign holders of Treasury securities sitting at over $7 trillion, they know how the system works, and they know the value of those holdings are going up. Now let's look at another chart now where we're going to overlay the 10-year Treasury yield with the nominal dollar. And I want to show you this. As you see the dollar here in blue rising in value, again, knee-jerk reaction, yields higher, and then all of a sudden yields go down because, again, as the dollar gets stronger, future dollars or Treasury bonds, they go up in value and yields go down. Here you see the dollar rising, yields going down, and as the Fed enters this tightening cycle and the dollar goes up, the natural direction should be for yields to go down despite market participants believing otherwise. Now, the question, though, is can the dollar maintain its status, or is there really an heir to the throne that's even better? Well, the dollar's leading rivals have their own drawbacks. As you can see, gold, which a lot of people believe should be back, but I'm going to tell you, it's not going to work because gold scarcity removes a key central bank policy tool. If central banks can't control the money supply, they can't adhere to respond to changes in aggregate demand. And the problem is it takes a long time for gold to settle because it's physical metal and it takes a while to move that thing around. So the idea that gold's coming back, well, that's not going to happen. Now, how about special drawing rights? Some people have said, well, that's going to replace it. Well, in their current form, SDRs can't be used as a direct medium exchange, and countries receive allotments from the fund, but they still need to sell the SDRs to another country or to the IMF to obtain actual currency. So here again, those are not designed to be a reserve currency. But what about the euro? I know some people think the euro could be, but the problem with the euro is it came to a near-death experience between 2011 and 2013 that still weighs on the minds of investors around the world, and it lacks a shared fiscal policy to match the European Central Bank, and their weak economic performance and bureaucracy, lack of innovation also limits their appeal. So the euro is not really ready yet. But China's the one that everybody thinks is coming, and well, I don't think that's going to happen at all. China's capital controls present a hurdle, as we talked about, and keeps their currency from freely moving about the world. And their global footprint remains tiny compared to the economic power. So everyone's focused on the economic power, but they're not focused on the currencies used. And currently, the yuan remains about 1.8% of the global payment system, and that is not enough to be a global reserve currency, not even close. And so what does that lead us next to? Well, you're probably thinking, well, I bet cryptocurrencies. Yeah, let's see what that's going to happen. And cryptocurrencies have proliferated into a myriad of coins and permutations, and those coins are created by splits and forks, meaning very few are being widely adopted as a means of exchange. And that's what the key part of being a reserve currency is. You have to have people transacting in it, not just people holding it. But that's not the other issue with crypto. Bitcoin in particular is volatile and it moves around a lot in price, and it has not been a reliable store of value, something that a reserve currency absolutely needs to do. So as the dollar's day is done, well, perhaps someday in my lifetime we'll see a new reserve currency coming along. But in the meantime, well, the IMF is just letting people know that perhaps its status is weakening a little bit, but its dominance is going to be here for a long time. I'm Steve Van Metre. Thanks for being fans. Thanks for watching. We'll see you soon. Bye now.